Ethan Harris, co-head of Global Economics Research at Bank of America Merrill Lynch. Thanks for your time.
Thank you.
All right, well, after months of speculation, the Federal Reserve did not announce a rate hike during its June meeting. Does that pave the way for a September rate hike, or is that still too soon?
I think the June meeting was kind of a placeholder. Nobody at the Fed really has confidence about the pickup in growth yet. We've only had about 6 weeks of better data after a very bad start to the year. So I think they went into this meeting thinking, we're not doing anything here, and we're going to send a very ambiguous message. We're hiking later this year, but we don't really know when. I do think that by the time we get to the September meeting this fall, Fed will be ready to hike. They'll have seen enough improvement in the data, but we didn't get any hint of that at the June meeting.
Investors seem to be obsessed about the Federal Reserve's actions, but if the Fed lifts rates higher on the heels of a better economy, won't that be good for stocks?
Well, I think that you have to distinguish between two kinds of Fed rate hike cycles. In some cycles, the Fed is fighting inflation. They really are trying to hit the brakes, slow down the economy, and control inflation. That's an unfriendly market Fed. This is not the unfriendly market Fed. This is the Fed wanting to normalize interest rates in the context of an economy that's improving and where they think the economy can handle the rate hikes. So in a way, hiking rates is kind of the good housekeeping seal of approval from Janet Yellen. It's her saying this economy is in better shape, it can sustain growth even with higher interest rates. So you could argue that it's actually a positive for the equity market.
It's an endorsement of where the economy is.
Yeah, it's an endorsement of improvement rather than a Fed trying to hurt growth. So it's a very different environment for the equity market in particular when you've got this more benign tightening cycle.
Now, the Fed also downgraded its GDP estimates for the rest of the year just last week. What does that mean for consumer discretionary stocks? If I'm an investor in that sector, should I be worried?
Well, I think that the downgrade was mainly about the terrible first quarter, which worked into their data. Remember, they forecast on a fourth quarter over fourth quarter growth rate, so that terrible first quarter impacts their annual number a lot. If you look at the underlying assumptions in their forecast, they're forecasting growth of about 2.5% to 3% in the second half. I would think that, like us, they're expecting the consumer to be part of that improvement. We've had the consumers in great health right now. You've had a recovery in the job market. You're getting a little bit of wage growth. Gas prices are cheap. Asset values are up. Stock market's done okay in the last few years. Housing market's doing better. So the general backdrop for consumer spending is still pretty positive, and I think that the Fed would endorse that view.
So that could be good for consumer discretionary stocks?
Yeah, I would think that, yeah. So the consumer's been a little disappointing at the start of the year, but you know, if we get some better data out there, I think it starts to feed into the equity market views as well.
All right, let's switch gears and talk about Greece real quick. Of course, it's a saga we've been seeing for some 5 years now, but if Greece fails to make its payment due to the IMF at the end of the month, I mean, do you see a contagion effect throughout the markets?
Well, unfortunately, with Greece, it's very hard to predict exactly how it plays out because in order to get a deal, you have to first have an agreement between the negotiators, and then you have to pass it through the parliaments in the various countries. So there's many points along the way where a deal can fall apart. So I think investors should be ready, or at least keep one eye out for further turmoil around Greece over the next few weeks. If they do exit, if they can't reach a deal with the rest of Europe, clearly there's going to be some short-term volatility in the markets. However, our team in Europe thinks that the European Central Bank has the tools to really help hold the Eurozone together, that they will, in a sense, hug the periphery, that is, be very aggressive in providing a support to the bond markets in peripheral Europe. So we don't think that a Greek exit or a near exit will mean a major crisis in Europe, and therefore we think it's a short-term shock to the markets.
All issues we'll be watching. Ethan Harris, thanks very much for joining us.
Thank you.